Mortgage rates just saw one of the biggest one-day jump we have experienced recently, all thanks to a surprise jobs report. The average 30-year fixed rate, as tracked by Mortgage Rate Daily, surged from 6.26% to 6.53%. That's over a quarter point increase in a single day, specifically 0.27%. Now, you might be wondering, is this just a blip or is it start to a new trend? Today, we are breaking down what this means for you and whether you are buying or refinancing, what to expect next. This sudden increase is one of the largest we have seen in quite some time, and it has a lot to do with unexpected strength of the labor market. Last week's job report was a classic case of the market was caught off guard. A stronger than expected report caused a sharp reaction in the bond market, driving mortgage rates higher. Let's talk about what exactly happened. The jobs report showed that the economy added 254,000 new jobs, much higher than 140,000 that was expected. On top of that, the employment rate dropped to 4.1% from the expected 4.2%. This kind of data suggests the job market is stronger than anyone anticipated, which in turn impacts mortgage rates. So you might be asking, why do these numbers matter? Well, when job growth is strong, it often signals the economy is doing well. More people working means more income, which leads to increased consumer spending. When spending rises, it can create upward pressure on inflation. Now, here's the catch. The recent strong jobs data might indicate that the Fed cut rates too aggressively last month when they lowered them by 0.5% or 50 basis points. The Fed had expected a slowdown in the economy, but these jobs numbers suggest otherwise. As a result, they might consider pausing their rate cut cycle or even reducing the number of cuts this year. Originally, the market was anticipating that the Fed would end the year with two more cuts, 0.25% in November and another 0.25% in December. But this strong report could change that outlook. The uncertainty is exactly what drove mortgage rates up so sharply, resulting in a jump from 6.26% to 6.53%, one of the largest single-day increases in recent memory. Now, let's take a look at the US 10-year Treasury chart. You will see that right when the employment data was announced at 8:30 a.m. Eastern Time or 7:30 a.m. Central Time, Treasury yields spiked dramatically. And it wasn't just a knee-jerk reaction. As the market digested the news, the yields continued their spike higher. Because it wasn't just this month's numbers. Past job data was revised higher too, which added more fuel to the fire. This left many market participants questioning how such a big shift happened after weaker reports in previous months. Federal and state government job numbers also played a role here, adding more complexity to the story. While the federal government jobs remained flat, state and local jobs added about 29,000 positions. Categories like healthcare and food services were even stronger, each adding 70,000 jobs. Now you may be wondering, why did rates jump so sharply? It comes down to how mortgage-backed securities work. When job numbers are much stronger, investors often pull their money out of bonds, which causes bond yields to rise. And since MBS are similar to bonds, mortgage rates also rise when yields go up. Another key reason is something called rate buckets. Mortgage rates are grouped into these buckets, and depending on where the rates fall, they can move up or down more dramatically than expected. This structure can lead to sharper movements when investor interest shifts. Looking forward, we still have more economic data coming this week, and these reports could have a significant impact on mortgage rates. Here's what to watch. On Thursday, we have the Consumer Price Index or CPI, which will tell us how inflation is shaping up. This is a big one for rates. We'll also get initial jobless claims giving insight into the labor market's current health. Finally, on Friday, we'll see the Producer Price Index or PPI and a preliminary look at consumer sentiment. These reports can influence investor sentiment and rate movements. While last week's job report was a huge beat, it's important to remember that one report doesn't define the trend. If the upcoming data shows any surprises, whether strong or weak, it could cause more volatility in mortgage rates. So, if you are considering refinancing or locking in a rate, keep in mind that things might still change. So before pulling the trigger, remember it's all about timing. This massive rate jump might not be the final word, especially if future economic data surprises us again. Remember, nothing goes up or down in a straight line, and you might get an opportunity to lock in a better rate at some point this week. Make sure to stay subscribed as I post daily rate updates from the top 5 banks, making it easy for you to keep a pulse on the market in less than 60 seconds. Also stay tuned for another video this week where I'll share a simple trick that can help you decide whether to lock your rate that day or wait until the next day. If you found this video helpful, please consider liking, subscribing, and hitting the notification bell. That way, you won't miss any updates. I'm following every twist and turn in the mortgage market to make sure you're prepared for what's next. Thank you for watching.